Kia ora, welcome to Shared Lunch, brought to you by Sharesies with BusinessDesk. My name is Dan Brunskill, I'm the markets reporter at BusinessDesk. We have a great offer for you, a special deal for listeners and viewers you can find out about at the end of this episode. But before we get into it, here's some important information.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
Today we're joined by independent economist Tony Alexander to talk about his latest Investor Insights report. Welcome back, Tony.
Great. Hi, Dan. Thanks very much for having us back again.
It's good to have you on. I feel like it wasn't so long ago we were discussing property, and now we're going to get into some other investments.
Yep. The wider field of investments, that's good.
Have you made any significant investments since we last spoke?
Myself. One. A haircut. It was starting to get a wee bit shaggy before. So, yeah, that's the big investment. I usually do 3 months, but this one was actually 6 months.
Wow, that's lockdown level here.
Yeah.
You've just put out a new Investor Insights report. Can you tell us a little bit about what this report is and what it covers and why you make it?
Yes, this is the Investor Insights report. There's something I do every quarter now where I send out an invitation to my 30,000 subscribers to my weekly Tony's View to give thought to how they're managing their portfolio of investments at the moment. And I ask them, are you looking at adding to your investments or not adding? I ask them, what might you be looking at buying more of in the near future or investing more of? What might you be looking at selling in the near future? And I ask maybe some more specific questions. Do you look at doing this yourself, through an app, through a broker, those sort of things? And what we've found is that compared with the previous one, which I did back in the first half of November, there has been quite a surge in the proportion of people who say they're going to be looking at buying more shares in particular. In fact, if we look back at November, I had about 46% of people saying, I'm looking at buying more shares. The average is 50%, so that was a little bit below average. People may recall that's when we were getting the inflation worries in New Zealand. The Reserve Bank, after the survey, then tightened monetary policy a record amount. This latest result is 59% of people saying they're looking at buying more shares. Now, we've seen some flattening out, some weakness in some share prices here and around the world, and maybe just people starting to think about they're looking at better investments. Maybe they're looking at the yield or anticipating economic recovery. But definitely a movement towards reinvesting back in the share market.
So the mood's become significantly more positive and actually more positive than average, not just more positive than it was.
Yeah, more positive than it was and more positive than the average, which is like I say, 50%. So at 59%, more greater than average proportion of people saying they're going to be looking at purchasing some shares.
Mm-hmm. That's interesting. I'm not sure that you want to speculate too much on the reasons there, but you did highlight a couple of things, such as, we're coming towards the end of the interest rate cycle, potentially. Share prices are really low. I was writing about a company today, and I thought, how much down is its share price? And when I looked in the last year, it was down 60%. I'm just like, wow, that's a big decline in the past year for this company that, it's ticking along okay. Do you think that's the sort of thing people are looking at and seeing and reacting to?
I think from a macro point of view, as opposed to, say, the technology sector in particular, where we've seen some huge share price change and there could easily be some bargain hunters starting to appear there. From the macro point of view, I think it is a greater feeling of confidence that interest rates, while still going up for a while, are not going to reach truly crushing levels. That if New Zealand has a recession, it's likely to be a relatively shallow one. And of course, what we see in the United States is that people, while not having optimism that interest rates are going to fall in a hurry, economic data are coming out showing that US growth is a little bit better for their economy than expected. Maybe consumers, with some of their higher than expected spending, are using up some of the savings they built up over the past 2 to 3 years. So maybe just a wee bit more economic resilience in there that people were looking at in the past. And of course, that means the yields. There's some scope there for some dividend improvement. And again, people are always looking for the bottom of a cycle. There's still a lot of money sloshing around the world looking for a home as a result of the money printing, of course, during the pandemic.
Mm-hmm. That's interesting. That's interesting to hear. And even though, the Reserve Bank is getting towards the level where it says it will stop raising interest rates, there is quite a lag between when the Reserve Bank lifts interest rates and when they have an effect on the economy, which sort of tells me that throughout this year, we're going to experience more sort of monetary tightening on the street, things are going to feel like they're getting more difficult and tight throughout the year. Do you think this enthusiasm for buying shares is maybe a little bit early? Do you think these people are sort of well-founded in their beliefs, or is this a bit premature?
Yeah, I don't know about premature. I think the thing to note is that, yeah, there are these two different things running along. Now, for people with a mortgage, you've got about $170 billion plus of those fixed rate mortgages that are now going to roll off on average around about 3.5% to something 6.5% over the coming year. That's about half of all mortgages out there. And so that will crimp the spending, which is what the Reserve Bank wants, of people who have already got mortgages. So there is a lagged effect to monetary policy, which is kicking through. When it comes to, say, the housing market, the effect is actually not in terms of, I was on this fixed rate, I'm going to that fixed rate, because the chances are if you've already got a mortgage, you're not looking to buy another house. And if you look in there, it's more the fixed mortgage rates seem as though they may have peaked. People are anticipating some slow improvement, and we can see first-home buyers, for instance, starting to come back into the housing market at the moment. And for the investors with general portfolios looking at the alternative of fixed interest securities there, the view is that these look like they have peaked out, essentially, and we could reasonably expect some mild declines in the near future. And so people know that signals that, right, eventually we're going to see some money from other investors move back into the share market. Maybe I'll move before they will. So I do think it is an anticipation of monetary policy easing, but yeah, definitely I think there's a risk some investors might be over-optimistic about how much interest rates will fall in the next 1 to 2 years, because this is not going to be a repeat of the Asian financial crisis 97-98 or the global financial crisis 2008-09, when for the first one, interest rates in New Zealand fell away about 5% for the likes of floating mortgage rates within a space of about 6 months. We saw a similar, slightly smaller decline with the GFC over the period of about 13 or 14 months. This time around, the fall in interest rates will be much less, and it's going to be spread out over a longer period of time because, with 7.2% inflation, there is, it's a wee bit entrenched at the moment. It's going to take a while.
Yeah. Yeah. It's really interesting to think about. It's complicated to think about the timing of these different things, because you have what's happening in the present, the Reserve Bank raising interest rates, the economy just beginning to slow, and then you have the lag effect that you know what's going to happen, and then you have financial markets and asset prices actually moving ahead of the events. So you kind of have what's happening now, you have the lag, and you have financial markets running ahead of everything. And it means things are moving in the same direction, or they're affecting each other, but on different time scales. It gets very hard to think about.
Yeah, definitely. Financial markets are forward-looking. Share prices are determined by people's expectations of what will happen in the future, not necessarily what is happening at the moment. And if we look, say, for instance, at just the inflation rate, 7.2%, this reflects the lagged effect of monetary policy being way too loose, too easy over 2020, 2021. And so the Reserve Bank, all of us economists, we know we've had this tightening in monetary policy in New Zealand since October, second half of 2021. There's a lagged effect which is still to come through. And like I say, there's a lot of people now, $170 billion plus worth of mortgages to be repriced. And if the Reserve Bank keeps tightening aggressively, the risk is the lagged effect of any extra tightening kicks through when the economy is already sort of weakening off. So yeah, they're sort of looking forward to what's coming down the track, and it's quite a difficult task. They got it wrong on the way down, eased too much. Hopefully they don't tighten too much and send us into a deep recession. I don't think they will, given some of the interesting things happening out there. But yeah, these are the things that move markets around, especially share markets.
Oh, look, that was my next question. I mean, we just had a rate decision, and there was a lot of talk there were a bunch of commentators coming out saying the Reserve Bank should hold off. We've just had a cyclone. We don't know the damage. We don't know the effects. It seems like the current higher interest rates are beginning to take effect on the economy. Maybe we should just pause. And the Reserve Bank didn't. They did 50 basis points, and they said that they considered doing 75, and they didn't really consider anything less, is what they said. What's your reaction to that? Do you think they made the right call, or should have they paused?
No, definitely the right call. We've still got inflationary pressures in New Zealand, inflationary expectations at too high a level, and devastating as the cyclone and the flooding has been for the people that are affected by it. If you look at, say, the Hawke's Bay, Gisborne economy there, That's maybe 3.5%, the New Zealand economy and population. Northland is about 2.5% or so. In Auckland, of course, it was highly localised, the damage there. So, we're talking 90 to, 93% of the economy and the population not actually affected by the flooding events. So that's not to downplay their significance, but the bulk of the economy, imagine the entirety of the South Island, all of us in Wellington, Taranaki, Manawatu, Wanganui, thinking, actually, if they cut interest rates or don't increase them, that's going to be quite positive for our housing markets and give a zhuzh up to the economy, which is actually not needed. Even before Cyclone Gabrielle came along, Treasury had estimated that the late January flooding in Auckland would add 0.4% to this year's inflation rate. And of course, we're going to get extra boosts of inflation from fresh fruit and veggie prices going higher as a result of what's happening in Hawke's Bay, Gisborne, etc. And of course, then there's the rebuilding. There's an economic stimulus to come. We did not have a recession in New Zealand after the Christchurch earthquake early 2011. There was an economic stimulus of demolition and then the reconstruction for years afterwards. And we're going to get an easing of fiscal policy this year. The flooding has made our country poorer. Wealth has been denuded in terms of infrastructure, people's wealth, the houses, etc. But it will cause a stimulus to economic activity in New Zealand. And given the unemployment rate at 3.4%, there's a risk it actually causes wages growth to pick up a little bit again. We'll see how that pans out.
That's interesting to hear, because I have a similar view on this issue, that it hasn't affected most of the country, and the effect the rest of the country will feel is somewhat inflationary. I mean, we all know, I think the place we all feel inflation the most is in the supermarket, because food inflation has actually already been running ahead of CPI. So you hear that average number, 7% or whatever, but food inflation is ahead of that. And if you're like me and you spend all of your money at the supermarket, you really notice. And I've been reading these headlines about all the food that's been wiped down the Hawke's Bay, and thinking just how much my salads are going to cost over the next few months. And I think that's like an underrated effect potentially, and means stepping off interest rate seems like a dangerous thing to do with that coming down the line.
Yes, especially with the tight labour market, because the Reserve Bank is explicitly allowed/required when it's setting monetary policy to look through short-term events that won't repeat. Usually that's with reference, say, to an oil price shock. So oil prices go upward, the Reserve Bank looks through that. They ignore it, they note it, but they put it to the side, and they want to see, will this lead to prices of things, second-round effects going up and up? Will it lead to faster wages growth? That's what they will be looking at. And so, that's a situation we've got here at the moment. If anything, the monetary policy response to the flooding is going to be higher interest rates and not lower interest rates.
That's really interesting. Let's get back to the survey. One trend that we've seen over the past, 3 to 5 years is increased interest in investing in the share market as opposed to residential property. Like people perhaps only 10 years older than me might have been much more focused on residential property. There has been an increase in people interested in the share market, partly because houses have become too expensive. What does the latest survey show in terms of that? How interested in people investing in the housing market versus shares? Has that trend continued?
Yeah, certainly. We saw the frenzy in the housing markets, of course, with the pandemic coming along, and then the taxation changes, LVR changes early 2021, and then more later in the year. For the first home buyers, I can tell from my surveys of mortgage advisors and also monthly of real estate agents that the first home buyers are starting to move back into the property market. No indication that they're doing it as investors. It's because they've got a good range of choice. They're not competing against investors. Prices have come down. And of course, the rental market is still relatively tight out there. They're getting good wages growth. They still got a job, etc. So that is happening. There is zero evidence, however, of investors moving back into the market. They need a minimum 40% deposit. As each year goes by, they lose more of the ability to claim interest expenses against the rental income, for instance. And so, the government, I think, has successfully removed sort of a layer of investor demand for property in New Zealand. They haven't generated a whole lot of sales of properties. There remains zero evidence of any wave of investors selling residential property because of the tax changes, etc. But there's no evidence of them stepping forward. But yeah, when it comes to the share market, we've seen with a lot of money floating around over the past 3 years, the new app technology, etc. A lot of people have got themselves into share markets and had some hopefully reasonably enjoyable experience and focused on the long-term wealth growth. Well, those positives are still sort of sitting out there, especially in the context of the labour market is strong. Once people, maybe if they've purchased a house, get their money, the mortgage down a little bit, start building up savings for the future. And for those young people who are not, of course, yet got their first house purchase, they're looking to grow their wealth to contribute towards the deposit over time. So, I think there is still definitely a strong level of demand for investing in shares over the longer term. Maybe especially because the share markets, they prove themselves time and again resilient to negative events when they come along, like the GFC, like the pandemic. We repeatedly see an initial sell-off as everybody goes, I wonder what everybody else is going to do. I think I'll sit back and wait for them, and they're waiting for you, and markets weaken. But then the focus again goes on the underlying fundamentals, resilience of one's economy, etc.
So you mentioned the number of people looking to buy more shares. I think it's the next 12 months. Was 59%. What does that number look like for residential property, and how does that compare to the sort of average?
Right. I don't have the residential property numbers in front of me at the moment, but they are relatively weak. And if I recall rightly, they did fall away a little bit there. And so that's why, I emphasise that while my surveys, 2 of them in particular, show first home buyers showing increased interest in the market, they do not show that the investors themselves are going back into the residential property market as well. I'll keep an eye on that, because if the rental market tightens up with some properties going back into Airbnb, now that tourism is growing far faster than people expected, net migration numbers are, through the roof. In 6 months, we've gone from an annual loss of 16,000 people to an annual gain of 16,000. Obviously, there's extra demand for accommodation, also from the flooding events, etc. There just might be some extra upward pressure eventually on rents, which maybe will bring some investors back into that property market. But I'd suggest that's still down the track, and many of them are going to be holding off, waiting to see what the election outcome is going to be, and if National win, if there will in fact be some of those tax changes.
Interesting. So the people who are looking to buy are really those who want a house to live in, rather than those who are looking for an investment or sort of a dual purpose investment accommodation. Sort of, it is really those people who are looking for a house to live in.
Yep, that's right. Yeah, the investors who are active, as they always are, would be those who don't have a mortgage. They're simply cashed up, so they're unaffected by the LVRs, the tax rules, etc. And those are usually people with a very long-term focus on their investment portfolio anyway.
Yeah. You mentioned the cyclone potentially increasing rents. I don't know. I haven't seen any numbers about how many houses have been damaged or destroyed, or how many people are going to leave the region. But what other effects could you imagine it having? Is it going to exacerbate our housing shortage?
Technically, at the margin, yes, in that I saw an estimate from one of the newspapers over the weekend of, I think, just over 300 houses red stickered, and I think about 1,400 that were yellow stickered, so work needed to be done before people could probably go back into them. As a proportion of the 1.9 million housing stock, it's not statistically significant at all, and I think the greater impact is more going to be on people giving thought to where they want to be located, to the flooding risk, and also to whether they're going to be getting the insurance. The insurance companies are now going to step forward, I think, even further with heavily increasing premiums for areas at risk. We tended to think of this as near the sea, but of course, as we've seen, as the large water catchments in some areas, or even not large if the downpour is great enough, and being near rivers as well. And if the insurance is not available, a fresh buyer is not going to get a mortgage in order to purchase that property. My understanding is in South Dunedin, where there was flooding a wee ways ago, and it's identified as with rising sea levels as potential to go under there was quickly about a 15% price differential, 15% sort of price discounting compared with houses nearby. I think that's shrunk away quite substantially now. People forget over time. They forget flooding events over time. And therefore, the response to this, it's only really going to have a long-term impact if we get actual rule changes by the local authorities, or more especially by the government, basically saying no to building in known at flood risk locations. And I guess what I'm hearing so far in the media is that the government is looking at having to do that, basically. And of course, having to also think about how do they buy out people who simply cannot go back to their places. It's already been done in the red zones after Christchurch, and so they should know how to go about doing this.
Yeah, interesting. So only 300 houses red stickered. That's not sort of significant enough to move house prices nationwide or anything.
Yeah, exactly.
You also mentioned, we talked earlier about the rebuild sort of being inflationary, and it's not just houses, but a lot of roads and infrastructure. And I think we all saw photos of bridges just being completely washed away. I don't know how much it costs to build a bridge, but it's a lot. That's got to be some sort of positive upswing for the building sector. And I'm sort of specifically thinking about the listed stocks here. But is that going to be, because there's been a bit of talk about there's going to be a building slowdown. Maybe some construction firms are going to have a difficult year or two. Is that still true, or has this kind of quote unquote saved them from the...
Yes. You see, this is where we economists need to be careful about what we say and how we say it, because technically there will be an economic stimulus to the building sector for the rebuilding. That is not the same thing as saying there is now a fresh upturn in the house building sector. What it actually is the decline in house building in the next 3 years is going to be less than would otherwise be the case, because there's going to be some rebuilding activity. And maybe the level of infrastructure expenditure, which was growing anyway, will grow slightly more than would otherwise be the case. Now, I know many people have fretted about the availability of labour, if not materials, in order to do a lot of the rebuilding on the east coast of the North Island in particular. I don't think it's going to be a concern, because the feedback we're getting from the home building sector is that there's a bit of a cliff somewhere in the second half of this year where projects will be completed, but the builders don't have anything new that they are moving on to. The real point of the spear here is with the architects, and the architects have been indicating for a wee while that their volume levels are falling away. The plans aren't being drawn up for the new multi-unit complexes, and of course, one reason is the banks have pulled back reasonably aggressively from financing a lot of this new development as well. They see potential for a recession in the economy. They see some stretched finances out there. We've seen a house building boom since late 2011, and just a feeling that maybe there'll be some individual sort of vulnerabilities out there. And of course, there's an expectation that some people who have signed up for new builds may not be able to settle when they're supposed to come up with the full money, maybe later on this year. So I think the resources will be available to assist with the rebuild there. And I don't think the need for the government to initiate new migration rules specifically for that is going to be as strong as people might in fact be thinking.
Interesting. That's a good summary. Let's pivot back to the survey. Noted in the survey that while there's a large group of people interested in buying shares, there's also a large group of people interested in selling. Among those looking to sell assets, they're most likely to sell shares. Can you talk about why they're both most popular to buy and sell? Does it just reflect the liquidity of shares? Why is it on the top of both sides of the list, if you like?
Yeah, I mean, shares are liquid. We don't tend to buy and sell houses very quickly, but we can easily buy and sell shares. And of course, an app facilitates that very well. And so what I got from my most recent survey was 14% of people saying, I'm looking at selling some shares in the next 12 months. The previous survey in November, that was 10%, so a decent increase. The average is 12%. So we've gone from just below average to just above average. I don't get too excited about that. But of course, what you do is you subtract those who are going to sell from those who are looking to buy, and you can get a net reading for overall purchases intended of shares increasing along the way there. I think when we look at selling, maybe part of the motivation will be we have seen some pretty extreme share price changes over the past few months, and I wouldn't be surprised at all if people are looking at, especially in the technology sector, thinking, well, maybe now some of these things could even be underpriced. I personally haven't got the foggiest idea. But there's never any shortage of people buying on the way down or speculating when there's going to be a bottom. in some of those stocks. So I wouldn't be surprised at all if some people are looking to sell some shares in order to free up some cash, and maybe when they see the market could be moving back upward again for some of these stocks, maybe themselves looking to join on the ride as well. So that could account for some of the desire to increase selling.
I know that's what professional investors have been doing, and it was really interesting looking at cash levels at the end of last year. Some growth funds, which target 4% cash, were holding 20% cash, and I've sort of never seen cash levels that high. And I sort of rung around all the ones at high cash and said, "What gives?" And they say, "We just think there's going to be better buying opportunities later this year." And some of them said, this is sort of beginning of February. They said already we've started to deploy some of that cash and putting it into the market. And I've seen that exact trend happen.
Yep. And I think we can actually maybe see a little bit of that in my survey as well. So I give people a range of different assets that they can say they're looking to buy more of, buy less of. And one of them I've got in there is savings accounts. And the latest result is 27% of people have said, I'm going to put more money into savings accounts. You see the interest rates have gone up. You're getting maybe up to 5.7% for a 1-year term deposit. So that's going to be attractive for some people there. But I think also people just looking to park cash. The previous result in November was 20% of people saying they were putting more money into savings accounts. So that is a statistically significant increase there. The average is 16%. So I think many people are looking to park money in order to be ready for when there's a bit of momentum in other asset markets out there, and look to take advantage of that, especially maybe when things are clearer with regard to inflation. We're still in a period where we know inflation's going to come down as a result of these interest rates going up, but we don't really know how rapidly. And we certainly don't know when our central banks are going to be able to say, job done. We're on track now. We're worried we might be over-tightening. We might loosen instead. That will happen one day, but we've no idea if that's in, September quarter this year or June, September quarter next year. But it'll come along, and I guess people just want to be ready for it whenever that does happen.
Yeah, it feels like even the base case scenario, the most likely scenario, doesn't feel that certain, and people are working off it as if it is true. But you can hear when you talk to them, they don't have that much conviction, that they say this is the most likely scenario, but there's a wide range, there's a wide tail on these things.
Yeah, and this is what I emphasise. I gave a talk to about 100 mortgage brokers, for instance, earlier on today, and I was just noting that the list of things which are unique is relatively strong. And let me take the easiest one. None of us had the foggiest idea, we proved this, when the pandemic came along, what was going to happen to our economies, house prices, unemployment rates, etc. Well, now we're into a unique environment we've also never seen before, a post-pandemic environment for economies. Well, I'd suggest we also don't really know how economies behave post-pandemic. One thing we're learning at the moment is that consumers appear determined to spend to a far greater degree than you would think, given the way interest rates have gone up. That's one thing. There's another unique element in this environment, and that is the unemployment rate is so unusually low, still at 3.4%. Businesses are still saying they're looking to finding difficulty getting skilled and unskilled staff. And I was just earlier on, about half an hour ago, having a look at the February ANZ's Business Outlook survey, and there's been a sharp decrease in the proportion of businesses saying they're going to lay off staff. We've pulled back from the big shock to the economy after the November 23 monetary policy tightening, and businesses are remembering, just like they remembered when the pandemic started, or a couple of months after, their biggest problem going into the pandemic was shortage of labour. I would suggest businesses are remembering that again at the moment. That has important implications because it means for the employees, I think I'll keep my job. I think I can get extra hours of work. And that means maybe I do keep spending on a new couch or overseas trip, etc. It also means there will continue to be cash flow looking to be invested somewhere as well.
Tony, we talk about investing in shares. Does your survey strip out the difference between investing directly in shares versus buying ETF or a managed fund? And have those trends changed at all?
No, definitely. So when we look at, for instance, managed funds, not much of a change. On average, 26% of people say they're going to invest more in managed funds. We're sitting at 27% from 23% back in November. So it's an increase, but it's only back essentially, statistically speaking, towards the average. And very few people ever say they're going to be selling managed funds 2 to 3%, that sort of thing. And for ETFs, I've got about 18% of people saying they're looking at investing more in exchange-traded funds there. The average is 14. November was 11. So that's quite an increase, actually. Not so much for the managed funds, but for the exchange-traded funds. More people looking to invest there. The selling, it's always 1%, basically. That number hardly ever changes for the proportion looking to sell from the ETFs.
Who sells a 10-year asset? Not very often.
Exactly.
That's really interesting because that's what I've anecdotally heard as well. And through some reporting, I've talked to a lot of people who maybe got into investing, buying direct shares, investing in Air New Zealand and Tesla. And that's kind of how they dip their toes in. But then they've found that they need diversification to ride out volatility like this. And they've found that doing their own diversification is quite time intensive. You've got to sit down and research a whole bunch of firms. So I've heard from more and more people who are saying, yes, I'm still investing, but I'm no longer buying direct shares. I'm now buying ETFs, and I'll buy something from a sector I like, and I'll buy the S&P 500, and I won't do so much stock picking. So it's interesting to me to see that is coming up in the numbers, even if it's a small effect.
Yes, exactly. And in fact, I was reading an article just yesterday, I'm not sure if it was Wall Street Journal or so, referencing Warren Buffett there and something he was saying in contrast to another gentleman a few years earlier, that the other gentleman was saying, no, he's going to be picking his own stocks and this sort of thing. The first one got very, very lucky. He got it on the ground with some of these things here. Another one, not quite so much. And the upshot was that maybe there is a bit more of a movement now that people have had a lot of experience through the accessibility of the apps. And, while the intention to purchase shares is fairly strong, people are starting to think about, that more of that longer term focus rather than having a bit of fun in lockdowns because there's not much else to do. I think we've got a trend movement away from that sort of environment.
Yeah, and it can be a mix as well. People will buy their high conviction stocks directly and then fill out the rest of their portfolio in ETFs for that diversification. So it kind of makes sense that both numbers head in the same direction.
Yep, definitely.
Perhaps a more controversial asset class that you survey is crypto, and I've seen that number go up in your survey and come back down again. Can you give us an update on where crypto buying intentions are?
Yes, I think this one, these survey results are responsive to changes in the crypto prices. And of course, we've seen the prices fall substantially from last year, sort of September quarter levels, etc., but bottom out with a little bit of an improvement over the past few weeks. And I think maybe that's what my numbers show. So on average, I've had about 9% of people over the duration of the survey saying they're looking at buying crypto. In November, that was just 4%. Things were starting to fall away there. So people were going, whoa, I don't think I'll look at that. Now we've had an improvement, but it's only 5%. I sort of think that gels with the extent of, say, the Bitcoin price change, high level, falling away. I think maybe we've got 19,000 US or so, and I think we're 23.5 or whatever at the moment. That's how I interpret the numbers I just quoted there as well. They seem to have a similar sort of profile to them. In terms of the proportion looking at selling crypto, that also is just 1%. Average 1% now, 1% in November. So it is more on the buying side where we tend to get some fluctuations. But it does basically show there has been a structural decline in general interest in purchasing crypto, given some of the developments, especially with some of the criminal cases, collapses of some of the exchanges as well. These are learning days still for, the structure, the infrastructure of the overall sector. And I've no doubt at all that things will settle down, but not everybody is prepared to remain in that sort of environment if you're not having a frenzy of the prices rising, and that can sort of cover up the odd loss here and there.
Yeah, again, you have the survey, I just have my anecdotes, but it did feel anecdotally like everyone was interested in investing in crypto for a while there, and now it feels like, again, it's just the true believers again. And you really feel like that top part of the market has sort of come off and said, maybe crypto is not for me, and it's just back to the people who are sort of very into it. That's what it feels like to me anecdotally anyway.
Yeah, no, I think that's a fair comment. Many people have done very well out of it. I did see some research about 4 or 5 months ago noting that about 75% of people had, however, lost money on their crypto investments. So I personally, I think it's been an amazing thing to watch there. But people just self-select. And for some, it's an asset they still want to have, a small 1 to 2% maybe of their portfolio in there. And for others, they'd rather reallocate that to something else. Personal choice.
Is there anything in the survey that you thought was particularly interesting or surprising or something that had changed?
I don't think surprising. No, I expected to see that a few more people would be looking at shares again, with signs of the market having bottomed out. There's been some big corrections out there. Maybe the amount of people looking at putting money into savings accounts was higher than I thought would be the case. Some money is being put to the side to take advantage of whatever new trends are going to emerge, maybe in towards the middle or the second half of this year. So yeah, that money in reserve, I'd suggest, was a bit higher than I thought would be the case, and that'll be interesting to watch where that money goes to. Again, we don't get an idea of the magnitude of these sort of things out there, but I think that was relatively interesting, at least.
Yeah, and that makes sense in a high interest rate environment. I think the survey also showed that intention to pay down debt was also high. That's correct, eh?
Yep, that's right. So a small increase in the proportion looking at paying down their debt, and with interest rates being at above average level, it makes perfect sense to do that if one has the cash flow available. And I guess I'm off the view that for the average person, I think the labour market's still going to remain relatively firm, that the ability to get debt down is going to be a bit better than a lot of people have been, I think, assuming it would be over the coming year.
Yeah. Yeah, that's another thing I'm hearing anecdotally. And actually the city council is looking at doing this. I find this interesting parallels between huge organizations and households, but Auckland Council has had a look at its Auckland Airport shares and said, do we need to own these or could we sell them and pay down debt? And I don't know whether it's going to do it or not, but it's definitely looking at selling its Auckland Airport shares to pay down debt. And I think that's an interesting little metaphor for our times and the financial calculus you might choose to do.
Yep, no, most definitely. Yep. And of course, it's always good to have a look at your portfolio for a bit of rationalization in terms of, if you think you want to pay down some debt, obviously have a good look through. Maybe you speak with an advisor, I don't know, in terms of, which assets maybe are you too heavily exposed to. We've been through turbulent times over the past, 3 or 4 years, deflation worries in 2019, and then the pandemic, record low interest rates, all sorts of weird things going on. So, it's highly probable that a great number of people have portfolios that may no longer suit their actual goals, their time horizon, their tolerance of risk, etc. So, having a sit down and just reviewing everything one has got there may not be too bad an idea.
Any one key takeaway or final message you have for the people of Sharesies community?
Yeah, I suppose just to address the issue out there, a lot of people accept that, recession is guaranteed for the New Zealand economy this year. And if you accept that reality, well, of course, then what pops into your head is some worrying scenarios of, rising unemployment, businesses going bankrupt, all this sort of thing. Well, if we have a recession, I don't think it'll necessarily be a deep one. B, it's actually not guaranteed we have a recession. I see forecasters with some, good number of people working on the numbers there seem to be pushing out the timing a bit further in time for when maybe a recession could occur in New Zealand late this year, early 2024. I'll just invite people to note that there are some new economic stimuli coming along. The early opening up of China, so 32% of our export receipts come from China. And so this is important for us in terms of extra growth in China is positive for ourselves. Tourism is growing far more rapidly than expected, and that's a large sector in the New Zealand economy. The net migration numbers have turned upward on a dime 12 months earlier than I thought would be the case. Job security, I think, is going to remain a relatively good stimulatory factor. The export education sector is picking up as well. There's an easing of government's fiscal policy coming along with the long-term infrastructure focus. So it's definitely not all negative out there. And hey, maybe that's one of the factors that's underpinning some of the increase in desire to invest in shares in expectation that maybe it's not going to be as bad as some of the media would necessarily have us believe.
That could be it. Okay, well, thank you so much, Tony. Really appreciate your insights, and we'll have you on next time you do a survey.
Look, thanks very much, Dan, and thanks everybody out there. All the best.
Thanks for tuning in, everyone, and a big thanks to Tony for joining us. We really appreciate your time and insights. We have a special offer for Sharesies investors from BusinessDesk. If you use the promo code SharedLunch2023, you'll get $100 off an annual subscription to BusinessDesk, which is usually $249, including GST. The offer only applies to new BusinessDesk subscribers and can only be used once per subscriber and can't be used with any other discounts. I hope you enjoy the rest of your week, and if you're looking for a good investment tip, maybe you should go get a haircut.